Thank you, Dong and Zhen for putting this paper on the program. It's a great pleasure to be here. This is John work with Discussant and Zhengyang. We're going to talk about payments, reserves, and financial fragility. Okay. As I invite you to think about this paper, I really want to invite you to think about the 4,000 years of money and payments starting from commodity money, like shelled, to gold, to fiat money, to the next generation of digital money. And when people talk about the evolution of money and payments, typically we talk about two factors. Number one being better and better technologies, meaning we can make payments in a more efficient way. And we can talk about stable price levels, meaning we want to keep inflation as low as possible. And those are indeed the two driving forces when we think about better money in the history. But in this paper, we argue that there is a third kind of overlooked factor, which is financial fragility. So what we mean by that, I want to be very specific. When we talk about payments, we also observe a lot of delays and interruptions in payment activities, even without any fundamental shock. I'm going to give you some examples here. I'm showing you the so-called big problem for small change. So the idea here, I'm showing you English clothing as a post-child of that, which was the smallest denomination of pennies. There was like 1/4 penny. It wasn't unuseful, as if you think about this value, it's about $6 in today's value. But the problem was that even if the government tried to boost the circulation, they always try to mint those small coins. They always gradually disappeared from circulation, despite them being useful. So we don't understand why that was the case. And then even when we talk about modern payments, think about large banks paying each other. So that's basically something, I mean, we think about cross-bank payments. So that's something underlying, like every day, if you want to send some money from your Bank of America account to your friend's Chase account, so that's essentially what happened. But for those large banks, we observe a lot of voluntary delays and interruptions, even during normal times on a daily basis. It's like those bankers, they wake up in the morning, even if they are well-funded, they have cash, but they always wait until afternoon, until other banks pay them, and they are willing to pay other banks. And this is indeed something underlying the notorious repo market crisis back in September 2019, when the overnight repo rate went up for nearly 1,000 basis. That was even something Jay Powell admitted as an important thing, which kind of kept him awake at night when he thinks about the next round of potential interest rate rise. I mean, right now maybe potentially lower, but that's something I want to highlight. Think about how important this question is. What's the root cause of payment fragility spanning those 4,000 years, starting from all these historic payments to today's modern payments? We want to understand this better. What we're going to bring to the table today is a very simple model, but hopefully we're going to make some new message here. We're going to start with a simple fact, meaning any payment must involve the transfer of a reserve good. And the reserve good is scarce. So I will be very specific about this. What do we mean that in the model? But the best idea here is it's in limited supply. Supply must be limited in the short run. You can never adjust the supply in the short run. And it's valuable also for other non-payment functions. That's something important. When you use those reserve good as a means of payment to pay each other, people do value them, but they value those things for other functions. So I would be very specific. But those two plausible assumptions actually lead us a very long way. We show that there is a conflict between payment and non-payment functions. That's going to imply a trade-off, meaning if you use those reserve goods, you pay each other. So you're going to get something, right? You're going to buy stuff, you're going to get some service. So that's going to give you gain from trade. But you do that because you transfer money, you move money, you give away money to other people
That means that you're worried about other people holding those money. You're worried about other people not paying you back, not making reciprocal payments in the future. And that's going to make you a little bit nervous when you use money to make payment today. And that's how we can understand a kind of endogenous strategic complementarity when you use those reserve goods as payments. From that, we show that in equilibrium, payments may become history dependent. You're going to look at other people's payment history to think about whether you're going to make payment. That can lead to an endogenous notion of fragility. We're going to use that to explain for a lot of historic events, episodes, and crises. Contribution threefold. So,
Sorry, yeah. When you say fragility, do you mean multiplicity or
it will be more than that. So we're going to show you first multiplicity, but it will be something more than multiplicity. So actually, I'm going to talk about this. This is actually one of our contribution. Now, let me first talk about some economics here. We're going to show that reserve scarcity, that in a very precise sense, it's going to cause payment fragility. I will be precise about the thing. It fundamentally arises from the conflict between payment, non-payment functions, as I mentioned earlier. And interestingly, even if we say better and better technology, it can never kill that conflict. So that's, I guess, something we really want to highlight here. And that implies a fundamental trade-off between price stability and financial stability, which is kind of a bridge between the micro and macro implications of this model. It's versatile enough to capture many applications. So I'll talk about them. And going back to Leah's point, we're going to capture fragility within a single equilibrium. We can talk about multiple equilibrium, but one contribution of this paper is we can talk about endogenous switching between different payment regions, even within an equilibrium. It doesn't necessarily require coordination motif, exogenous coordination motif, as you typically see in like diamond typic or other kind of coordination games. There is actually no coordination motif in any stage game, but we can endogenously generate an dynamic coordination motif. So let me introduce the model. It's a fairly simple dynamic model. There are two agents, and they are they're impatient, so they care about their consumption today, but they also care about future. There are two goods. I really want to talk about the difference between those two. There is a single unit of indivisible reserve good. You're going to use that as a means of payment. But importantly, it also holds value of other non-payment functions. You can think about stored value or other intrinsic value. Important, I guess one thing I really want to highlight is you realize that value, stored value, when you hold this reserve good, you keep it still, you keep it in your pocket. And that's how you realize intrinsic value, stored value. And that's going to reflect different types of opportunity cost of using this reserve as a means of payment. When you use it for payment, it's going to generate something we call rewards. That's different from reserve. Again, I'm giving applications. But the fundamental idea is if you move the money, if you give away the money, if you let it, in action rather than being still, it's going to create some value. It's going to create rewards only when you transfer the money. So that's like the fundamental conflict here. Being like you keep it still, you're going to realize store value, but if you let it move, you're going to create rewards. However, reserve and rewards, they are not substitutable. So you can never just simply save those rewards to create more reserves. That's going to capture the idea of scarcity in the short run. Let me give you like a timeline of this model. Imagine me and maybe Zhigu also. Now we can make some payments to maybe we can buy stuff and we can sell some stuff. And I have the reserve good today, so I'm thinking about maybe I want to get a haircut. But I cannot do that for myself, so that captures the idea of labor division. This is captured by the payment shock. Yeah, this is private. Now the question is whether I'm going to pay Zhigu or not. So that's something I can decide in private. Maybe I don't want to pay him. That's why I don't get a haircut today. Subway move to the next period. So maybe I'm tempted to get a haircut again. But what I can do today is I can pay him, meaning I'm going to transfer the reserve to him, subject to a technology shock, meaning the money could be lost in transition. or if somebody just stole it, but if it gets through, it's gonna give me a haircut. That's gonna generate me the reward. Gain from trade, but I have to give up something. Because at this period, right, I can no longer use this as something, to show off or to enjoy, because historically people also use gold as a conductor. The intrinsic value, or we can use that as stored value. I have to lose something, opportunity cost. I have to give up that, and we can calculate the present value of opportunity cost if the reward never give it back to me. This is something we call scarcity. If the present value for other non-payment functions is higher, it means that this reserve good is more scarce. Remember that. So this is something super important. Now it's his turn. He's subject to a payment shock. He might want a haircut. He couldn't do that himself. He's going to think about whether to pay me or not. He could do that. Giving it to me, subject to another technological shock. And then if it gets to, I'm going to provide a haircut. It's going to join the reward, but he has to give up opportunity cost as well. And basically we alternate. Fairly simple model, but we're going to use this to capture a lot of interesting things. Again, as I said, so this is status model. We don't got at price levels. There's no money supply in different forms. There's no private versus public money. We don't talk about endogenous emergence of money. We don't talk about credit mortgage, but we really want to highlight the conflict between payment and non-payment functions. And as I showed you, it's going to lead us a long way. In terms of applications, it just showed you gold and silver, right? So that's historical metallic payments. Obviously, we are in limited supply, and you can get rewards. That's consumption goods, services. You can, it's not that easy for you to convert those things into gold or silver. We can talk about cross-bank payments using central bank reserves. So if you're interested in the institutional details, the idea is when banks, Bank of America, Chase, they make payments across each other, they have to open an account at the Fed. That's called Fed Master Account. And they're going to transfer central bank reserves across those accounts. They are in the supply, it's subject to monetary policy implementation. But if you use this for payment purpose, opportunity cost, right? You're going to give up your interest income. It's going to be harder for a bank to meet reserve regulatory requirements, and maybe you even have to tap discount window again. That's cost. There's a conflict there, and when you do those things, you can collect fees from your clients. But those are basically lendable cash, right? They don't necessarily have to go to central bank, the Fed Master Account, so they're not exactly substitutable. When we talk about US dollars, this is related to also Zheng's work and also my discussion Zhengyang's work. You think about cross-border payments, right? Again, that's a huge market. US dollars, so that's the dominant currency, which people use a lot to pay dollar invoiced goods, and also they use US dollar to settle financial contracts. So that's the dominant currency we use for payments. But opportunity cost, we use US dollar as a reserve asset for stock value. So it's different. It's a different role from its role as means of payment, and there are conflicts. When you do that, right, you can collect fees in local currencies. They're not perfectly substitutable with US dollar, and we can talk about next generation of payment stablecoin and CBDCs. So I'm going to show you the results. Equilibrium, I'm going to show you two benchmarks, good equilibrium and a bad equilibrium. Good equilibrium meaning whoever holds the reserve always make payments, regardless of payment history. We don't care about what the other people is doing. We always send the money. So that only happens when reward over scarcity of the reserve is higher. I mean, you only do that when the reserve is not so scarce. In particular, it means that you don't matter too much about its non-payment function. You don't matter too much about stock values. You're going to use it for payments. And we can talk about, for example, why checking deposits are typically non-interest bearing. Because checking deposits, they are designed for payment functions. If you offer people interest, so that's going to generate a higher conflict between stock value row and means of payment row. So that's going to be another perspective to think about why banks typically have market power in deposit market. Because it makes sense, right? If you really want to promote the payment function, it doesn't make sense for you to interest on that. There's another benchmark, bad equilibrium, people never make payments. That only happens when the reserve good is very scarce. when kappa, when they over kappa is smaller, meaning kappa is larger, the reserve good is very scarce. You care a lot about stock value, and you don't really want to use it as means of payment. So that can help us understand the example I mentioned earlier. Big problem for small change. Remember, so this is not the Grinch's law, right? This is not really about good money versus bad money, because we're talking about the same money, just in different denomination. But the whole point is, if you think about those small coins, right? They're simply too valuable as stock value, right? In crisis times, you can just buy those coins, you can use them to mint and other stuff. So that's a fundamental reason why people want to hold it, because the transactional value that those small coins can support is simply too small over the stock value function of those. Okay, going back to Leah's point, so we can show that there is a region in which we have two equilibria coexisting, and that can help us understand why those prices may happen. So we can use up the sunspots to think about the jump between those equilibrium, and that can allow us to think about those crisis episodes. But as I said, so this is not enough, right? We don't want to stop here, because I mean the whole idea is we have multiple equilibrium, but we have to understand why a switch between those equilibrium happens, right? What triggers the switch between those different episodes? And what we're going to do is we're going to kind of deepen the approach. We're not going to use sunspots. We're not going to use global games, right? Those selection mechanism. What we use here is we follow the repeated game literature. We can talk about history dependence of payments within an equilibrium. I'm going to show you an example calling green trigger payment equilibrium, right? So this is related to the idea of green trigger strategy in presence dilemma. It's like the basic idea is, again, so thinking about Zhu and me making payments to each other, right? We are friends, we always make payments, but maybe at some point I don't trust him anymore and stop making payments, and then he's stopping making payments to me. So we break up, but that's fine. So the basic idea here is how we can think of that as a threat to support successful payment today, and how can we think about the potential endogenous switch from a good equilibrium, from a good episode to a bad episode. Think about this, right? There are two possible reasons of not saying a payment from Zhu. Number one is maybe he doesn't want a haircut, right? That's fine. Or maybe somebody basically stole the money. So that's fine. That's not about him, right? So I should still trust him. But there could be a reason in which he wants to get a haircut, and nobody wants to steal that money still. He simply doesn't want to pay me. So that's something I care about, right? Because I can use that to infer in the future, if I pay him, how likely he's going to pay me back. So that's something I care about. Fundamentally, in this problem, we're going to use the signal of getting a payment as a signal to infer his intention for this coordination. So what I'm going to show you is we prove that there is a region in which the green trigger equilibrium exists, and it exists when the reserve good is not too scarce, but also it's not too abundant. Intuitively, if it's too abundant, obviously we don't have to punish each other, right? We always make payments, as I said earlier. But the more interesting part is it's going to happen. The green trigger equilibrium needs a more abundant reserve to be able to happen. So this kind of shows you when the reserve is more abundant than this, you have the good equilibrium. And now, because of this threat, right? I'm going to punish you, but still you are willing to make payments today. So that requires reserve to be even more abundant. That's how we understand this green trigger equilibrium. But again, the idea of this green trigger equilibrium is shows you that within an equilibrium, this switch can happen. It doesn't necessarily need an exogenous shock for us to think about how we select the tendrils equilibrium. This is something I highlighted earlier. This fragility will not go away, even if technology becomes perfect. In this case, nobody's going to steal the money, and it will always go through. But still, we have this region in which green trigger equilibrium happens. Intuitively, that means that people can never blame technology anymore, right? Technology is perfect. That means that it's all about him, not willing to pay me. It's not about technology. So that basically raised the bar for us to build the trust, for us to reach this coordination. So that's exactly the idea of why adequately the green trigger equilibrium still exists. The final step of our paper is, I just give you an example of green trigger equilibrium. In equilibrium, there could be, a lot of different other types of dynamics and patterns in terms of how we coordinate payments along the time dimension. So what we do here is, I won't talk too much about the detail, but we got some technique in the empirical literature. We're going to capture the full equilibrium payoff set. So instead of capturing all the equilibria in terms of strategy, we're capture the welfare of those two agents. So that would allow us to understand. So when we change economic environment, how that's going to change the outcome of the equilibrium. So we're going to speed those results. But the fundamental idea here is we're able to capture all the possible welfare outcomes. Okay, let me conclude. So in this paper, what we do is we use a very simple model to capture hopefully some new message. This is related to the fundamental conflict between these two roles as means of payment and store of value. Typically, people think of those two roles as complementary to each other, but we really want to highlight something different. And we show that it's going to lead to fundamental some intrinsic fragility. We think about payments, and it can allow us to think about different applications. One question we're trying to think about is going forward, right? This is a fintech conference. We make it a little bit more fintech. Think about the future. Think about next generation of these payments. What payment system will thrive in the future? Obviously, it's not a quantitative model, but I think key message I want to convey is we need a technology which not just focuses on superior technology, but also we need to economize the demand for reserves. We would try to think about technology which can help us minimize the conflict between those different groups of money. Thank you.
Does anyone know how I can make this?
Just click on the stack.
Okay, thanks. All right. Great pleasure to discuss this paper. So let me do that. So this paper is about payments and reserves, and those are the two key functions of money or near money assets. And we tend to think about this, for example, in the context of dollar. On the one hand, we need the US dollar to settle transactions in international trade. And on the other hand, we also want to hold dollar as a hedge against bad shocks. It's also a reserve asset. This paper in particular does a really good and intriguing job of documenting the history of money in its capacity of those two roles. So I really enjoyed reading that bit. Thank you. And just to contrast what Yao was saying in relation to the traditional view, we tend to think about these two roles as being complementary, because if a money is safer, I would like to use it for transactions because I don't have to worry about its quality. And if the money could be used for hedging purposes, then traders, merchants, companies would be more willing to accept it as a means of payment. So those two things tend to go hand in hand. What this paper shows is to highlight new tension between these two roles. Because if reserves are scarce and valuable, and I risk not getting them back if I pay it out, then I do not want to use it for payments. I want to hold it for myself. So just to be more precise, here is my attempt of replicating the model in a more simple version. So I have two agents, you and I hold reserve today, you don't have reserve. And if I transfer the reserve to you in a transaction, this creates a value of Z util to myself. However, here's the trade-off. Reserve is valuable, and if I give up reserve, I lose the utils today, and I'm forward-looking. So in the future, if I still do not have the reserves, I keep losing the utils C discounted at the rate of delta until I have my reserve back. So in this setup, we have two equilibria. The good equilibrium is one in which I pay you the reserve in the even periods, and you pay me back in the odd periods. So we create value from our transactions, which are Z's, and these are higher than the cost C, and that sustains trust, and that sustains the good equilibrium. We keep paying each other, and our transactions create value. There is also a bad equilibrium in which I hold this reserve. I do not want to do any transaction because I understand that if I give you the reserve, you won't ever give it back to me because you will do the same. So in this case, I do not deviate from the bad equilibrium as long as the one period gain from transaction Z is lower than the present value of all the future benefits of having the reserve. So now we can see that these two parameter regions actually overlap with each other. And that is an interesting intersection because in that intersection, we would have multiple equilibrium, which means that payments are fragile. One day we wake up, then everybody panics, everybody stops paying each other, and that is a self-fulfilling outcome. The intuition here is very much similar to diamond and big. So the correlation would change as a payoff. So we would end up in either the good or bad equilibrium. There's more in the paper. For example, they also consider the dynamics within the good equilibrium. For example, if the payments could fail to happen if there's no need for transaction, or if there's a technical glitch, even with the need for transaction, then we could observe one period in which the payment does not happen. And if the agents interpret the absence of payment as a signal of someone intentionally doing the bad behavior, then this triggers, again, everyone panicking out and putting the permanent punishment. And in this way, even when we start with a good equilibrium, but there is a chance 1 minus lambda mu, which is what Yao was showing in this picture, there's a chance that we would observe a failure of the payment, and that creates further failure of transactions down the road. Authors also have very interesting welfare implications. And overall, it's a very interesting paper, both strong on the theory side and on the anecdotes and these reflections of our monetary history. So my takeaways. If I can rewind the clock, I guess back to 2020, 21, there's a lot of papers talking about microstructure issues, which is used to explain the quality on both the payment side and the reserve asset side. So for example, when the treasury bonds are cheaper, that's usually when we observe bigger bid-ask spreads. So this reflects an illiquidity premium from the traditional interpretation. Also, if we think about what happened in 2020, 2019, there were interbank payment and repo market disruptions. And these issues were related to the issues with the plumbing of the financial system. So there are microstructure perspectives to these issues. But at the same time, there are also macro fundamentals. And I've been a firm believer that this matters. For example, I studied the relation between the value of reserves and the fiscal backing behind them for both the US, the Eurozone, and also in the history of financial hegemons. And if I learned one thing from this, I think it is the following. While the microstructure issues provide valuable diagnostics, I think they may be manifestations of something bigger, the macro issues in the background. There's a reason why we get the glitch in the payment system. There's a why we see the bid-ask spreads widening up in the repo or treasury market, and they may be manifestations of the macro issues. And what got me very excited about this paper is that they provide us a theory, perspective, a tool to connect between those two sides. And I would like to give a bit more comments and thoughts on this connection. So my main comment is about distinguishing between scarcity and quality. So this model emphasizes the reserve assets scarcity as a key determinant of equilibrium outcomes. In the model, there's one unit of indivisible reserve with exogenous C, this value capturing the scarcity. But in reality, scarcity is more probably time varying, and maybe more interestingly, the scarcity or the quantity of the reserve is actually determined by its quality. For example, if we think about financial crisis like in 2008, the reserve became scarce not because its issuance went down, but because some reserve assets became not safe and not reserve assets anymore, such as the ABS. So the effective supply went down because the quality of some reserves deteriorated. So in the context of this model, I think that the quality or quality-induced scarcity could be endogenous to the value on this asset from its payment equilibrium. And that could give rise to further multiplicity, which I think is very interesting. And also, if we have a more explicit modeling of the quality or scarcity, this could also open up the possibility of directly thinking about and modeling policy response. What should we do if a payment failure happens? Do we want to supply more reserve or payment assets, or do we want to do something else? I think that's an interesting policy question that can be studied from this model. I also have another related comment, which is about heterogeneity in the reserve assets. Both from the international perspective and domestically, we have a competing set of multiple reserve assets or payment assets. And the competition or coordination could be quite interesting. I think the key question here is whether the competition between different payment systems or assets relax or exacerbate this trade-off that the authors talk about in the data or model. And this also reminds me of something I learned growing up. It's called Gresham's law. The bad money drives up good. So if I have two monies, one is a better store of value than other, then I'll keep paying other people the bad money and I keep the good money to myself. I think an extension of this model could formalize this intuition from a theory perspective, which would be very interesting. And even more interesting is to consider the case of maybe some private information, because then we could begin to conceptualize the notion of trust and uncertainty in the payment system. And I think this is exactly something that's complementary to this multiple equilibrium fragility idea that the authors studied in the paper. So let me sum up. The authors are after really a big idea here. Do the dual roles of money, or broadly defined, create a conflict between its payment and reserve functions? The model is very simple and elegant, but very thought-provoking and challenging the existing ideas. The paper is polished, but I think more maybe can be done along the lines of thinking about indulgence issuance, quality, and competition and coordination. Thank you.